Hello, Chapter 10, the Foreign Exchange Market. Our learning objectives: describe the functions of the foreign exchange market, understand what is meant by spot exchange rates, recognize the role that forward exchange rates play in insuring against foreign exchange risk, understand the different theories explaining how currency exchange rates are determined and their relative merits, identify the merits of different approaches toward exchange rate forecasting, and compare and contrast the differences among translation, transaction, and economic exposure, and explain the implications for management practice. The foreign exchange market, also known as the Forex market, is the market for converting currency of one country into that of another country. Exchange rate is the rate at which one currency is converted into another. Future exchange rates cannot be accurately predicted, and foreign exchange market provides some insurance against foreign exchange risk. The functions of the foreign exchange market: currency conversion. In general, within the borders of a country, the national currency is used. Businesses use the foreign exchange market to, number one, convert payments received for its exports, income received from foreign investments, or income received from licensing agreements with foreign firms. Number two, make payment to a foreign company for its products or services in its country's currency. 3. Invest cash for short terms in foreign money markets. 4. Engage in currency speculation, carry trade. Spot exchange rates: the rate at which a foreign exchange dealer converts one currency into another currency on a particular day. It changes continually, and the value is determined by supply and demand. Insuring against foreign exchange risk is continued. With foreign exchange rates, we have a foreign exchange is when two parties agree to exchange currency and execute the deal at some specific date in the future. Exchange rates governing such future transactions are forward exchange rates. They are a date in the future, and they're usually quoted 30, 90, and 180 days out forward. Bear with me, I think I lost my place. Thank you. Insuring against foreign exchange risk. So we have something called currency swaps. It's the simultaneous purchase and sale of a given amount of foreign exchange for two different value dates. And it's transacted between international businesses and their banks, between banks, and also between governments, and also between governments and banks. And the common type, it's spot forward, spot against forward. There's a global network of banks, brokers, and foreign exchange dealers connected by electronic communication systems, and this continues to grow rapidly. But the most important trading centers are London, which is the largest, New York, Zurich, Tokyo, and Singapore. A market is open 24 hours a day. High-speed computer linkages among trading centers around the globe have effectively created one single market. People can also profit through arbitrage. What arbitrage is the purchase of securities in one market for immediate resale in another to profit from a price discrepancy. Most transactions in the Forex market involve the dollar. The law of one price. In competitive markets, free of transportation costs and barriers to trade, such as tariffs, identical products sold in different countries must sell for the same price when their price is expressed in terms of the same currency. Purchasing power parity, or PPP. It's a comparison of prices of identical products to determine the real, or PPP, exchange rate. An efficient market has no impediments to the free flow of goods and services, and the price of a basket of goods should roughly be equivalent in each country. There's something called the Big Mac Index, which basically takes the price of a Big Mac in each different country, and then you compare the price of that. Prices and exchange rates continued. What about the money supply and price inflation? Well, the growth rate of a country's money supply determines its likely future inflation rate. Inflation is when the money supply increases faster than output increases, and an increase in the money supply makes it easier to borrow, which increases demand for goods and services. A country with a high inflation rate will see depreciation in its currency exchange rate. Hyperinflation is an explosive and seemingly uncontrollable price inflation in which money loses value very rapidly. and also government policy determines growth rates. Empirical tests of the PPP theory. Exchange rates are determined by relative prices. Changes in relative prices result in a change in exchange rates. Accurate in the long run, but not a strong predictor of short-run movements in exchange rates 5 years or less. It best predicts exchange rate changes for countries with high rates of inflation and underdeveloped capital markets. Failure to find link between inflation rates and exchange rate is called the purchasing power parity puzzle, and there are reasons for failure. It assumes away transportation costs and barriers to trade, while these factors are significant and create price differentials between countries. Price discrimination by dominant enterprises, and governments attempt to influence the value of their currencies. Interest rates and exchange rates. Interest rates reflect expectations about likely future inflation rates, and it's called the Fisher effect. If the real interest rate is the same worldwide, any difference in interest rates between countries reflects differing expectations about inflation rates. The International Fisher effect, and it's the formula right here. Investor psychology and bandwagon effects. Neither PPP theory nor the International Fisher effect is particularly good at explaining short-term movements in exchange rates. Impact of investor psychology on short-run exchange rate movements, and bandwagon effect where traders move like a herd. It's a very emotional response. Summary of exchange rate theories. Relative money growth, relative inflation rates, and nominal interest rate differentials are all moderately good predictors of long-run changes in exchange rates, but they are poor predictors of short-run changes. The efficient market school. Efficient market is when prices reflect all available public information. Forward exchange rates should then be unbiased predictors of future spot rates. However, inaccuracies will be random. The inefficient market school. The inefficient market is when prices do not reflect all available information. Forward exchange rates will not be the best possible predictors of future spot exchange rates. Approaches to forecasting. We have something called fundamental analysis, and this draws on economic theory to construct sophisticated econometric models for predicting exchange rate movements. It includes relative money supply growth rates, inflation rates, and interest rates, and possibly balance of payment positions. Technical analysis. It uses price and volume data to determine past trends which are expected to continue. There are analyzable market trends and waves that can be used to predict future trends and waves. It has gained favor in recent years. 3 forms of currency convertibility. 1, freely convertible. Government allows both residents and non-residents to purchase unlimited amounts of foreign currency. Externally convertible. Only residents can convert their holdings of domestic currency into foreign currency without any limitations. And number 3 is non-convertible. Limiting convertibility. Governments limit convertibility to preserve their foreign market reserves. Capital flight occurs when there is a rush to convert domestic currency into a foreign currency, and most likely to occur when domestic currency value is depreciating rapidly. Companies deal with non-convertibility by engaging in counter trade, barter-like agreements. The foreign exchange risk through the 360 view, managerial implications. You have transaction exposure, extent to which the income from individual transactions is affected by fluctuations in foreign exchange values. Translation exposure, impact of currency exchange rate changes on a company's reported financial statements. And then economic exposure is the extent to which a firm's future international earning power is affected by changes in exchange rates. A company can do everything right in terms of selling its product and it being at a profitable rate, but then all of a sudden you have an economic exposure where the exchange rate fluctuations could actually change something from profitable to unprofitable. Reducing translation and transaction exposure. You do this once by forward exchange rate contracts, buying swaps, and then you have something called lead strategy where you collect foreign currency receivables early and thus prevent them from fluctuating or changing in value. And then you have a lag strategy. This is delay the collection of foreign currency receivables, particularly if the currency valuations are going down. Reducing economic exposure. Distribute the firm's productive assets to various locations so the firm's long-term financial well-being is not severely affected by adverse changes in exchange rates. Other steps for managing foreign exchange risk include need central control of exposure to protect resources efficiently and ensure subunits adopt correct mix of tactics and strategies. Number 2, distinguish between transaction and translation exposure and economic exposure. Number 3, need to forecast future exchange rate movements. 4, establish good reporting systems so the central finance function or in-house foreign exchange center can regularly monitor the firm's exposure positions. Number 5, produce foreign exchange monthly exposure reports. I thank you for listening. Have a great day.